This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. For your listening enjoyment today, I want to present a chapter from my 5th edition of Trend Following, my audio book of the 5th edition of Trend Following. Now, I did not narrate this. I guess I should have, but if you ever write a book, especially one with 200,000 words, recording that is a hell of a lot different than free-forming on this podcast. Reading a script is an absolute beast. How those folks can read a teleprompter and look even remotely natural, I have no earthly idea. So without any big lead up from me, let's jump right into a very important chapter from my 5th edition of Trend Following. Sit back, enjoy, and if you learn a little, drop me an email. I'll send you even more. I'm serious. Send me an email. My email address is really easy. It's my first name at mylastname.com. You send me an email, I will send you a video presentation to go along with this podcast episode. Without any further delay, let's jump right in and please enjoy this episode.
Chapter 7. Decision-Making. Would you tell me, please, which way I have to go from here? That depends a good deal on where you want to go, said the cat. Lewis Carroll. We see heuristics as the way the human mind can take advantage of the structure of information in the environment to arrive at reasonable decisions. Gerd Gigerenzer. Trend-following strategy approaches day-to-day trading decisions in a way most would not recognize. KISS. For example, each day millions of fundamental traders around the world attempt to evaluate a relentless onslaught of confusing, contradictory, and overwhelming market information, all to hopefully make profitable trading guesses for that day. For example, the type of information on daily finance news. Although they know decisions should be educated and, based on factual data, they see impulsive action as sound decision-making, leaving them with absolutely no clue. They either end up paralyzed and make no decision, let someone else decide, or guess. It's a vicious and repeating cycle of decision-making frustration. Terence O'Dean, a professor at the University of California, Berkeley, uses a roulette wheel to illustrate. He postulates that even if you knew the results of the last 10,000 roulette spins, knew what materials the roulette wheel is made of, and whatever 100 other pieces of information you could dream up as possibly being useful, you still will not know what matters, where the ball will land next. Ed Seykota takes O'Dean's thought a step further in critiquing decision-making. While fundamental analysis may help you understand how things work, it does not tell you when or how much. Also, by the time a fundamental case presents, the move may already be over. Just around the recent high in the live cattle market, the fundamental reasons include Chinese buying, mad cow disease, and the Atkins diet. Trend followers excel because they control what they know they can control. They know they can choose a level of risk. They know they can estimate volatility. They know the transaction costs. However, there is still plenty they know they do not know, but in the face of that uncertainty, they still step up to the plate and swing. That ability to make a decision is core to trend trading philosophy, that is, swinging the bat without fear. Those decision-making skills might not appear worthy of endless discussion, but the philosophical framework of that decision-making is critical to execution. If we were to keep the trend-following style in baseball terms, the question would be, do you want to play ball or not? When the pitch comes, if it's your pitch, swing the bat. There is no time to wait for more information before you swing. In an uncertain world, if you wait until the data is clear, The ball has crossed the plate. You miss the pitch. You are out. Occam's razor. Tackling the challenge of making smart decisions in a complicated market world is hardly new. As far back as the 14th century, when medieval life was as rigidly complex as its cathedrals, philosophers grappled with how to make simple decisions when pressed for time. In any scientific realm, especially when a new set of data requires the creation of a new theory, many hypotheses are proposed, studied, and rejected. And even when all unfit hypotheses are thrown out, several might remain. In some cases, they reach the same end but have different underlying assumptions. To choose among similar theories, scientists and trend traders use Occam's razor. Occam's razor is a principle attributed to logician and Franciscan friar William of Occam. The principle states entities must not be multiplied unnecessarily. In its original Latin form, Occam's razor is pluralitas non est ponenda sine necessitate. This bit of Latin still underlies all scientific modeling and decision-making. A common interpretation of the principle is the simplest of two or more competing theories is preferable. Occam's razor does not guarantee the simplest solution will be correct, but it focuses priorities. Fast and frugal decision-making. In the field of cognitive science, economics, and trading, it has always been assumed the best decision-makers have the time and ability to process vast amounts of information. Not true. The field of heuristics explores how to make constructive, positive choices by simplifying processes. Gerd Gigerenzer's Simple Heuristics That Make Us Smart shows how to cope with complexities using the simplest of decision-making tools. His premise? Fast and frugal heuristics employ a minimum of time, knowledge, and computation to make adaptive choices in real environments. For example, a component of fast and frugal heuristics is one-reason decision-making. This is what trend followers do when faced with a trading decision. One-reason decision-makers use only a single piece of information for making a decision. This is their common building block. Therefore, they can also stop their search as soon as the first reason is found that allows a decision to be made. Whether your decisions are about life in general or trading in particular, your decision-making process should not be complex for the sake of complexity. You make the trading decision, buy or sell, on a single piece of information of price. The great trend traders share character traits with other achievers across other fields, such as quick reactions or being able to turn a position on a dime. When you are faced with a decision, going with a first instinct is almost always the right choice. If you reflect and consider options and alternatives or try to second-guess, you will end up making the wrong decision or the same right decision, but only after taking valuable time to get there. Gigerenzer elaborates. Fast and frugal heuristics can guide behavior in challenging domains when the environment is changing rapidly. For example, in stock market investment, when the environment requires many decisions to be made in a successively dependent fashion. These particular features of social environments can be exploited by heuristics that make rapid decisions rather than gathering and processing information over a long period during which a fleeter mind competitor could leap forward and gain an edge. Consider how players catch, like in baseball. It may seem they would have to solve complex differential equations in their heads to predict the trajectory of the ball. In fact, baseball players use a simple heuristic. When a ball comes in high, the player fixates on the ball and starts running. The heuristic is to adjust the running speed so the angle of gaze remains constant. That is, the angle between the eye and the ball. The player can ignore all the information necessary to compute the trajectory, such as the ball's initial velocity, distance, and angle, and focus on one piece of information, the angle of gaze. Former baseball catcher Tim McCarver drew the same conclusion, and he is in no way a trained decision-making scientist. Before each delivery, the catcher flashes a hand signal to the pitcher indicating the best pitch to throw. Imagine that a strong batter faces a count of 3 balls and 2 strikes, with runners on first and third. What should the hurler serve up? A fastball high and inside, a slider low and away, or a changeup over the heart of the plate? By the way, Mark McGwire's up next. You have to put down a sign quickly. The first one is going to be the right one. For most baseball decisions, you can train yourself to be right quicker than in 5 seconds. McCarver is talking about bare-bones decision-making with incomplete information. Be quick is his central tenet. The transition from fast and frugal decision-making by a baseball player, McCarver, to fast and frugal decision-making by a baseball team owner and trader, John W. Henry, is remarkably smooth. Henry was one of the first to focus on the use of heuristics in trading. At the New York Mercantile Exchange, the president of John W. Henry's firm talked fast and frugal. We're a trend follower. We use price information and volatility in order to make decisions. The reason why we do that is because we don't think we can predict the future. Further, I can't be an expert in every one of them markets. In fact, I can't be an expert in any of them, so what I have to do is be able to be an expert at being able to move faster when I see information that's important. So my way in which I can move faster is to just use the price information that's the aggregation of everyone's expectation. What we try to do is extract the appropriate signals as quickly as possible so we can act fast to limit our risk and also create opportunities. We're frugal in the senses that we use very simple recognition heuristics, the price information itself. What could be an example of this? We like to think of those as nonlinear models, but it's no different than what some people describe as breakout systems. His simple heuristic for making trading decisions is price action. But there is more. Finding a price trend among noisy random price moves presents a challenge similar to that of filtering information from the noise in many other applications, such as astronomy, audio, ballistics, image processing, and macroeconomics. For example, engineers who track ballistic missiles based on noisy radar information attempt to filter out noise to determine the missile's direction. Similarly, macroeconomists and central bankers who receive imperfect economic data, such as estimates of GDP for countries and unemployment rates collected from many sources with errors, try to assess whether an economy is heading into a recession or is overheating. Investors trading on trends in financial markets face the similar challenge of assessing the direction prices are headed by filtering noisy price data. In the world of audio, Ray Dolby developed the Dolby system to reduce noise in music recordings and enhance the signal that the listener hears. Along the same lines, trend followers use quantitative tools to enhance the signal of the price trend and reduce the noise around it. The use of quantitative tools does not mean complicated analysis. The fewer trading decisions traders make, the better. This may seem counterintuitive, but in a complex world where decisions have to be made with limited information and real-world time constraints, time to consider all possible alternatives is not an option. Trend following is inherently simple, but very few want to believe, especially many respected market players, that something simple can make money consistently. The reason trend followers do well is because they stay focused and very disciplined. They execute their game plan, and that is their real strength. Not everyone agrees with the science of fast and frugal heuristics. One group said, "This can't be true. It's all wrong. It could never be replicated." Among them were financial advisors, who certainly didn't like the results. Another group said, "This is no surprise. I knew it all along. The stock market's all rumor, recognition, and psychology." However, staying exclusively with the simple heuristic of price is tricky. Traders can't help trying to improve. They become impatient or even bored with systems. Far too many like to make decisions even if those decisions are short-term emotional fixes that have zero to do with making a profit. For example, let's say you have a buy signal for Google. You must buy the stock if it follows rules. You must trust the rules and your decision-making to follow the rules. Don't make it more complicated than it is. Buy when you get the signal. That's not to say that trend following in its entirety is elementary. However, the decisions that go along with it should be processes you can jot out on the back of a napkin. Innovator's Dilemma. Clayton M. Christensen, author of The Innovator's Dilemma, understands trend following, even if not by the name I use. What Christensen understands are odds and reactions. He saw this as readers attempted to decipher his work. They were looking at Innovator's Dilemma for answers rather than for understanding. They were saying, "Tell me what to do," as opposed to, "Help me understand so I can decide what to do." Wall Street analysts are theory-free investors. All they can do is react to the numbers. But the numbers they react to are measures of past performance, not future performance. That's why they go in big herds. Wall Street professionals and business consultants have enshrined as a virtue the notion you should be fundamental data-driven. That is the root of companies' inability to take action in a timely way. Christensen drives home again that you must make decisions without all the facts. You cannot foresee how a changing market will look until change has taken place, and then it's too late. Take, for example, an up-and-down stock such as Yahoo. You probably said, "I should have bought here and sold there." But there was no way you could have predicted the future of Yahoo. You could only act early before the direction of the trend was obvious. You must be in ready-set-go mode long before pundits say the coast is clear. They are the herders Christensen slams, those in the sheep business. Consider another decision-making story similar to Tim McCarver's baseball example. Years ago, the catcher and the pitcher called pitches. Today you still have a catcher and a pitcher, but the coaches are usually calling the pitches. Why? So the pitcher can execute exactly what he's told to do. When the typical major league pitcher gets a signal to throw a curveball, he doesn't stand out there on the mound debating it. He says to himself, "This is the system we're using. I have a coach on the sidelines with a computer. He's studied and charted everything. He knows I should throw a curveball. The only thing I'm going to worry about right now is throwing the curveball to the precise location that I'm supposed to throw it." The pitcher then can concentrate solely on execution, the best pitch possible he can throw right now. Likewise, as a trend follower, you wake up and see the market move enough to cause you to take action, like a buy signal. For example, let's say the rule dictates buy at price level 20. You do it. You don't debate or second-guess it. Sure, that might feel boring, and it might feel like you're not in control. It might feel like there should be something more exciting, more adrenaline-fueled, more fun for you to do, in which case consider a trip to the Spearmint Rhino in Vegas. If you want to win, however, you execute the signal as prescribed. That means you trade at price level 20 and throw the curveball when called for by the coach. Fun, excitement, and glamour are not what you want. Executing correctly to win is what you want. Process versus outcome versus gut. The decision-making process is that, a process. You can't make decisions based on what you want the outcome to be. Michael Mauboussin has long presented a compelling argument for process. In too many cases, investors dwell solely on outcomes without appropriate consideration of process. The focus on results is to some degree understandable. Results, the bottom line, are what ultimately matter. And results are typically easier to assess and more objective than evaluating process. But investors often make the critical mistake of assuming that good outcomes are the result of a good process, and that bad outcomes imply a bad process. In contrast, the best long-term performers in any probabilistic field, such as investing, sports team management, and pari-mutuel betting, all emphasize process over outcome. Building on that wisdom, Edward Rousseau and Paul Shoemaker, professors in the field of decision-making at Wharton, present a simple tool, see Figure 7.1 in the supplemental PDF, to map out the process versus outcome matrix. The process versus outcome schematic shown in Figure 7.1 is built into trend trading systems. For example, imagine the process you use to make a decision is sound. If your outcome happens to be good, you can view your result as deserved. On the other hand, if you use a good process and your outcome turns out bad, you take solace with failure as a bad break, but you achieved it with a good process. Trend trader Larry Hite put it another way. There are 4 kinds of bets. There are good bets, bad bets, bets that you win, and bets that you lose. Winning a bad bet can be the most dangerous outcome of all, because a success of that kind can encourage you to take more bad bets in the future, when the odds will be running against you. You can also lose a good bet, no matter how sound the underlying proposition, but if you keep placing good bets over time, the law of averages will be working for you. That's sage advice from one of my favorite thinkers, but the romance of in-the-moment, no-process gut decision-making remains a strong pull-in for modern world. From admiration of entrepreneurs and firefighters, to the popularity of books by Malcolm Gladwell and Gary Klein, to the outcomes of the last 2 U.S. presidential elections, instinct over process is positioned as ascendant. Many push intuition as the X factor separating men from the boys. Gut decisions, they say, are needed in moments of crisis when, they say, there is no time to weigh arguments or calculate the probability of every outcome. Gut decisions are made in situations, they say, where there is no precedent and consequently little evidence. There is a place for gut decision-making in life choices, but it's not applicable to the markets. If you have no market process and focus on profit outcomes alone, it will end badly. Guaranteed. Summary food for thought. Ed Secoda. One pretty good heuristic is trade with the trend. Occam's razor dictates if 2 equal solutions, pick the simplest. Fearless decision-makers have a plan and execute. They don't look back. If something changes, they adjust. Murray N. Rothbard. If a formerly good entrepreneur should suddenly make a bad mistake, he will suffer losses proportionately. If a formerly poor entrepreneur makes a good forecast, he will make proportionate gains. The market is no respecter of past laurels, however large. Capital does not beget profit. Only wise entrepreneurial decisions do that. Tom Asacker. The process, not the proceeds.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.